Pretty cool seeing some familiar faces in here. I see Jordan, Cam, Hayden, some other folks that I know. Pretty cool. So hopefully this is valuable to everybody. I know everybody's come from different walks of life here, or different levels of capital raising. So um, you know, welcome everybody. I'm Seth Bradley, Chief Legal Officer at Tribevest. I'm a securities attorney. I'm a fund manager myself and all around entrepreneur. Pumped to have everybody here. So let's just get right to it. Today, we're going to show you how to raise more capital without co-GPs, without institutions, and without handing over your deal to someone else, losing control. You're going to learn the strategies, the structures, the systems that the pros are already using to scale without sacrificing equity time, and of course your sanity as an entrepreneur. We need to protect that for sure. And before we get started, know that if you stick around to the end, we're going to have a massive giveaway, but only if you stay to the end, and we'll provide that link. Real quick, legal housekeeping. So this presentation is for educational purposes only. It's not legal, tax, or investment advice. And this is really important because people tend to get this confused. Tribevest is not a law firm, not a CPA, not a broker-dealer, not an RIA. And yes, I am an attorney, but I am not your attorney. I don't think, but maybe some of you out there, I am your attorney, but not in this capacity. So always consult your own advisors, and let's get into it. And one more thing, make sure that as questions come up, go ahead and type them in the meeting chat so that we have those and we can go through those at the end. So feel free to pose those, and send them directly to Rohan if you don't feel comfortable putting it in the overall chat. All right. Yeah, this slide, Rohan really got me here. So who is this guy, right? We need to update these slides because I don't really look like that anymore. This was my old law firm photo when I had the big wave hair. You can see it's grown out quite a bit. I don't really look like that anymore, Rohan. We've got to update that. So anyway, first, to get into my world, I did set up this QR code, and it's really a gateway into a ton of free stuff that I used to sell for thousands of dollars. So scan that and let's stay in touch. You can get into my social media and all that kind of stuff. So I've closed billions of dollars in real estate transactions as an attorney, a capital raiser, a deal maker. I've worked in big law. I worked in big law for over 7 years before I started my own boutique securities law firm, raised law. I've founded companies. And most importantly for this presentation, I'm a fund manager, I'm a syndicator, and I'm an operator of real estate. So I'm on the business side too. And that 360-degree perspective is why I'm here today, because I know exactly how this game works, where people get stuck, and how to set yourself up to win. I understand y'all's problems because I have them too. I'm living in them myself every day. All right, so here's the industry challenge, right? There's this wall. It's not a literal one. It's a regulatory, it's a psychological, it's a logistical wall between you, the general partners, the lead sponsors, the folks that want to raise capital. And then on the other side of the wall are these accredited investors. Now, we know that there are millions of them out there. I don't even honestly know if that number is big enough, but that's what we have right now. There are millions of them out there, right? And we're all trying to figure out how can we get in front of them? How can we raise capital from them? But there's an invisible wall because you're only one person, right? And you feel like you can't access them. And we're all out there on podcasts, or we're on social media, or we're doing newsletters, whatever it is, we're trying to get in front of new investors. And it's, at the end of the day, it's really hard, right? Like, it's really hard to access these capital partners, even though we know they're out there. And the rules, of course, are confusing as well. So the SEC has certain rules and regulations we have to go by to how we go about raising capital and contacting accredited investors or even non-accredited investors. And today, we're going to tear that wall down. So the old way of raising capital, it's broken. I like to call that the old way because it's the co-GP way, right? Like, right after, well, I should say the story starts in 2012, right? So the Jobs Act in 2012 gave us the opportunity to get away from just the country club good old boys access to deals, and we started being able to advertise and solicit for deals under certain parameters. And that triggered this whole new game of capital raising and getting access to private investments. And that's when you saw the big boom, right? Between 2012, it took a few years to get started. And then really up until maybe even 2023 when the interest rates started spiking up, but it's still going strong today. But the problem is, us as entrepreneurs, us as real estate investors, we always push the limits of what we're allowed to do. And that's where even the term co-GP got started. Really, there's no such thing as a co-GP. You're either a GP, you're either an active partner in the deal, or you're not. And that's it. And we in the industry have coined this term co-GP as kind of this way of saying, hey, you're a partner in the deal, but really all you're doing is raising capital. And that's illegal, right? And we'll jump into that a little bit later. But there are other challenges as well, right? Like the retail investors' trust has been eroded recently, and for good reason. They've been hit with capital calls. They've watched deals underperform in the last couple of years. They've watched them fail. Even worse, they've been caught up in fraud and Ponzi schemes, and all the while they're navigating an economy that's just full of mixed signals and just rising uncertainty. We've got potential wars, we've got longstanding wars, we've got all these ups and downs in the economy. So it's really difficult for passive investors to get comfortable. So it's been very hard to raise capital. It makes them cautious, skeptical, and just slower to commit. And you guys have seen that out there. Co-GPs, again, we already talked about that, but from the lead sponsor perspective, there's just too much risk and confusion. You're really inviting strangers into your company, and that's risky. And we all know that sometimes we turn the other cheek to co-GPs, or to the rule that you're not allowed to have 7, 10, 20 co-GPs because it's just not compliant. But we've done it in the past, but we're getting away from that. I think everyone has seen that some folks have either gotten in trouble or have almost gotten in trouble, and that's kind of scared people away from doing that any longer. So if you're still doing that, don't do it. I highly advise you not to do that, and we're going to provide a solution today that can get you around that through the fund of funds. And last but not least, institutional capital. It sounds great, right? First of all, you have to get access to it. You have to be attractive enough to get them to be interested in your deal, and you have to have a deal that's big enough for them to even want to invest. Sometimes they require a large investment, which sounds great on paper and in theory, but if they want to invest a minimum of $20 million and you're only trying to raise $2 million for your deal, well, they're not interested. So it does become a problem. And they demand voting rights, managerial rights, takeover rights, things like that. So outside of those two options, you really need a structure that gives you the speed, the control, the scalability, less friction, more compliance, and access to, again, that trusted network of passive investors so you can get beyond that invisible wall. And that's the opportunity with our Tribevest Fund of Funds program. So enter the Fund of Funds model. You don't give away control. You don't give away managerial rights or voting rights. And that's because a fund of fund is really just an entity that invests passively in your deal. They're just another passive investor. They are not a GP or a co-GP or an active partner. They're just coming onto your cap table as a passive investor. So you don't need to bring on other business partners. You don't run the risk of co-GPs doing something stupid, getting you in trouble, or making you look bad. You stay in control of your deal, and someone else, an independent capital aggregator, which is what we call them, or an ICA for short, they aggregate the capital into a clean single-purpose vehicle, an SPV, that wires one check and occupies one line on your cap table as a single passive investor, and in turn handles all their own passive investors and all the headaches that you guys know comes along with all those individual passive investors. So you can tell by the graphic that fund of funds model gives you access to each of these ICA's qualified accredited passive investors. Real quick, just a few definitions so that we're all on the same page. Fund of funds, a fund, it's its own fund. It's simply an LLC. That's all it is. So if you guys have put a syndication together or you've put a fund yourself together, this is the same thing. All it is another fund, another LLC that you set up. But the difference is it now, instead of buying the asset itself, instead of buying this apartment building, it actually buys interest in your deal or in a target deal. And in turn, that target deal buys that apartment building. So it just shows up as a passive investor in the target deal or in the lead sponsor's deal. And this entity, of course, just like yours, has its own set of offering documents, has to file for its own exemptions, has its own quote unquote general partners, has its own limited partners or passive investors. With those general partners, of course, being the operators, the lead sponsors at your level and also at the fund to fund level. And fund to fund level, we tend to call them ICAs at Tribevest, or sometimes we'll refer to them as fund managers. And they take on the operational risk, and of course, they get rewarded for that with more returns and more opportunity. While the limited partners, the passive investors, limited risk, of course, only their invested capital is at risk. And of course, that comes with a little bit less opportunity and lower returns compared to the general partners. Special purpose vehicle, I mentioned SPV. Again, it's just a legal entity, such as an LLC, that is created for a very specific purpose and brings specific value to its members. So a fund of fund is or can be an SPV, depending on the form that it takes. And at Tribevest, that's the form that it always takes. An independent capital aggregator, an ICA, that's, again, a term that we've coined here at Tribevest. It's a capital raiser with a network of potential limited partners that they can bring into a deal. And a subset of those are co-GPs, right? People that just raise capital, probably shouldn't be doing it that way. And fund managers is also kind of a subset of those ICAs. All right, the conduit. This is a great slide. It really shows you what we're trying to do here, what we are actually doing here at Tribevest. Uber didn't build a taxi company. They built a marketplace where everyday entrepreneurs launched their own taxi company with just a car and a phone. And Airbnb, huge company, obviously, did the same thing. They didn't open a hotel chain, but what they did do is they opened up a marketplace and they gave anyone with a spare room the infrastructure to run their own hospitality business. And those platforms unlocked entrepreneurship at scale for that specific subset of entrepreneurs. And Tribevest is doing the exact same thing for capital raisers. So we're giving ICAs, again, people with investor networks, a compliant, scalable platform to launch their own capital raising business. So instead of hospitality, instead of a taxi business, it's a capital raising business. And what that means for you is that you can get access to those 1 million plus entrepreneurs that are being created every single day. So quick comparison here, co-GPs versus fund to funds. And we'll go through a couple other alternatives as well. But co-GP model, we already talked about it a little bit, and many here are familiar with that one. So, you've got the compliance risk. Many co-GP structures violate SEC regulations by involving unlicensed capital raisers, right? If you're raising capital, if you're raising capital and getting paid for it in a certain way, you should be a broker dealer. So we've ended up, we've ended up with 7, 10. I've seen up to like 25 co-GPs in a single deal, which is insanity. I mean, you probably shouldn't have more than 5 total GPs, depending on the complexity of the deal. But wow, I've seen up to 25. And, if the SEC looks at something like that, I mean, it's clear as day a violation. Like if they ever had a reason to look at it. The good part is most of the time they don't. But when a deal goes bad and passive investors start getting angry and they start wanting to sue someone, they start talking to state commissioners, the SEC, and then people start getting in trouble. Next, the messy cap table, right? So each co-GP ends up on the cap table and in the operating agreement as the GP. So you as the lead sponsor, you're inviting these co-GPs who you really don't know, and you're probably giving them some sort of control, some sort of decision-making power, and they're ending up actually in your operating agreement as partners. Well, I know for me, I don't want to go into business with people I don't know, because down the line, people don't get along, people stop doing their jobs, people don't attend meetings, it just starts to fall apart. And you're actually seeing that now today, where a lot of these co-GP groups from a few years ago have just started to erode and fall apart. And some of these apartment buildings and other types of investments have just not gone very well for the investors, unfortunately. And really, it's unscalable because, again, if you get too many people in the same deal, it's not compliant. So it's not scalable. You have an inconsistent investor experience and behavioral risk. Each co-GP may communicate differently to their limited partners, or what you really see is not at all. They don't communicate with their limited partners, but they're part of your investor. They're part of your group. They're not just their investors, they're your investors. So again, they could potentially ruin your reputation just by being associated with you. Again, they may not follow the rules, whether that's legal, whether that's ethical, whether that's performance wise, and that just it reflects bad on you. The fund of funds model, SEC compliant, if structured correctly, it is a little bit more complex. So we got to make sure that we structure it the right way so that it's completely compliant, but structured through SPVs with proper legal docs and exemption filings and investor protections, it is compliant. A much cleaner cap table for you as a lead sponsor. They just show up as one passive investor, one line item per SPV. There's no clutter, no surprises, and it's super simple. Really important here, you retain control. The fund manager does not get voting rights. They don't get operational say. They have their own fund and they control, and they have control of their own fund and their own structure, but not yours. It's scalable because you can work with 2 or 5 or 25 fund managers in the same deal because they are just passive investors to you. They're not general partners. They're not co-GPs. So it's scalable. Unified investor experience. You control the story. They deliver to their network because it's their own fund. Because the only investor you need to worry about is your investor, which is that fund to fund. They deal with their own passive investors. And because of that, there's less overhead. They have to handle their own setup, their own offering documents, their own investor onboarding, banking, K1s, investor portal, all the stuff that you do at the lead sponsor level, they now have to do as well, but they have to do it at their fund to fund level. Real quick, against institutional capital, longer timelines, excuse me, right? Due diligence can take months, slow your ability to close. Higher demands, institutions often negotiate for control, more fees, special terms. Anyone that's went through that process knows this. Larger minimums, a lot of institutions want to invest a minimum of $5 million or maybe $20 million. And if you just have a single syndication or a single apartment building or whatever it is that you're trying to buy, that's a lot of money and you can't place it. And they're not interested in placing $500,000 or $1 million or $2 million. Concentration risk, a lot of times they're going to take up the entire equity stack. So, they're relying. So you relying on that one big check makes you very vulnerable, especially close to closing if it happens to fall through for whatever reason. And then you don't really have a backup plan and you don't have enough time to raise from individual passive investors at that point. Fund of funds, faster to commit. Often ICAs have a warm capital already ready. They have their passive investor network ready to go. There's not a 6-month DD cycle or anything like that. You have aligned incentives, or at least you can make it that way, and we'll help you structure it so that incentives are aligned. Fund managers win when you win, and they're in the trenches with you. So, and again, this is diversified capital, but in a good way, not too diversified. So you can have 3 to 5 SPVs that each bring in, let's say, $500,000 to $2 million each. Still really big checks, meaningful money, but reducing that single source risk. So low barrier to entry. You don't need $1 billion track record to raise through fund of funds. And we can talk about that later. And we actually help you build that marketing machine as well. Compliant and scalable. Again, one check, one K1, one line item on your cap table. And for the fund managers who don't know how to put all this together, we handle all this stuff at Tribevest. So I've named all these different things that the fund manager now has to do that they didn't used to have to do as a co-GP. Well, that's what made it difficult, but that's the big problem we solved at Tribevest. So anybody out there who here has tried or who here has scrambled to raise money at the last second, whether that's through a fund of funds, whether that's because you're trying to close on a property, whether that's through a syndication, type me in the chat box right now. So I know that I have, and it's one of the most nerve-wracking things in the world. You really worked hard to get this deal under contract. You got through due diligence. You're working through the debt. Like, you're doing all this work. You love this property. You love this deal. You know that if you can get this thing closed, that the passive investors are going to have a great ride. But it's really hard, right? And you're on you are on a ticking time bomb. And it's even harder to sell a deal when the investors can sense that you're desperate, right? Like if you have this deal and they know that they can tell, like when you have those conversations with them and they can tell that you're desperate and you need, you're $500,000 short and you've got a week left to get it, they know it. So they sense that desperation. If they feel that desperation, they tend to not invest. Like they don't like desperation. They don't like being pushed around. They don't like being sold. They want to be wanted. So desperation does not work. So if you've been in this business long enough, it's likely happened to you. And raising capital by setting up your fund manager program before you have a deal helps you de-risk your raise. All right, number one problem for fund managers. I've hyped up the benefits of fund of funds, but let's talk about the biggest problem with the fund managers themselves. Fund of funds are catching on, but great fund managers, what you're seeing out there, are becoming really harder and harder to come by. Because if they're really good at it, they're in demand. And the best ones already have a pipeline of deals, a pipeline of sponsors coming across their desk that they're already perhaps working with or want to work with. And it makes it really tough to stand out as a lead sponsor, and especially one if you haven't necessarily developed your program yet. And that's why I encourage you to get started as soon as possible, because we'll go through some examples here soon of some of the big names out there that have already done this and have got started, and they're already out there attracting fund managers to their program. They're already out there making their own fund managers from their passive investor network, and you've got to get started today so that you can compete and you can raise capital effectively. And again, the solution that we found with numerous sponsors is to create an internal fund manager program so you can consistently identify, qualify, and onboard new fund managers. We partner with lead sponsors time after time and help them develop their own programs. And we know how to attract quality fund managers and develop fund managers from passive investor pools. And we're actually working on perfecting that program as kind of a standalone thing. And we'll offer that to you guys soon. And we know what fund managers are looking for. We've worked with hundreds of them at this point, and we know what they're looking for. We know what makes them successful. We even know which ones, at least the ones that have been around the block, are successful. So we just have a really great view of the total market out there. So if you're a lead sponsor, here's the opportunity. Turn on a new committed capital channel through a thoughtful, formal fund of funds program. Access investor networks that you don't have and you can't reach. Again, it's that invisible wall that we're trying to get across. Stay in control of your deal, gain confidence in the equity raise, and these are just a small sample size of the lead sponsors that we work with. These are some pretty big names there at the top that you guys have heard of. I'm sure some of you look up to that are doing a lot of deals in a really difficult market. That's tough to do, and some of these folks are really pushing through there. And these are real case studies. So these are real numbers. This isn't made up. This isn't fluff. This is the real deal. So Lone Star, one of our great clients, program results, they've done 4 deals. I think this was last year. This probably needs updated a little bit, but 4 deals. They had 6 ICAs, their fund managers, 11 fund of funds, and they raised almost $6 million through those fund of funds. So they opened up that channel. They committed to it. They built the program with us, and they're seeing a lot of success from it. Viking Capital, you guys have probably heard of them. They do a ton of great marketing. Program results: 4 deals, 6 ICAs or fund managers, 12 fund of funds, and $9.4 million raised through their fund of funds program. Again, they made the commitment, they went all in, and we helped them build that program. Aspen Funds, probably one of our most successful clients, highly respected in the industry. Lots of different types of assets that they raise for: oil and gas, private credit, multifamily, industrial. They do a lot of different things through 4 funds and 29 fund managers. They've done 28 fund of funds and raised almost $18 million. I think it's way over that at this point. I think it's much higher than that at this point, but $18 million plus, and brought in over 200 individual passive investors through those fund of funds programs. So you can see that this isn't theory. These are our actual clients that are committed to building a formal fund to funds program with Tribevest. So these are real raises that happen faster and with less friction. And these lead sponsors can depend on this. So like they can go into, they can put out LOIs on deals or partner with folks and say, I'm going to raise capital for your deal in the eyes of Aspen, for instance, and they can do it confidently because they know that they already have this formal fund to fund program built out that they committed to, that they know that they can depend on. So what is Tribevest? Tribevest is the back end that makes all of this easy. So we're a platform built specifically to support ICAs. We handle everything that you can think of. We handle the SPV formation. We do compliant offering documents. We do your exemption filings, investor onboarding. So getting all these passive investors to walk through their documents, sign their documents electronically, wire their funds. We all know, anybody that's done this knows it's such a pain. We do all that for the fund manager. We do the tax filings, the K1s. We have integrated banking. So we open up the business banking account. We file for the LLC, get the EINs. We'll do the fund manager entity if indeed they need one. We even do the cap table configuration, and we'll even do the distributions of the fees and distributions to the investors down the line. So we do everything. It's soup to nuts. Lead sponsors and the ICAs can stay focused on raising and executing, and we just handle all the messy stuff that you normally have to piece together with a CPA and a securities attorney and an investor portal and all these other different things that you'd have to do. We do it for you here at Tribevest. So far, these are older numbers, but just to give you an example where we're at, well over 100 fund managers, 150 fund of funds, many more than that, and well over $100 million plus raised through our system. So the new way versus the old way. Note that the biggest problem to solve the outdated co-GP model is not what, but it's how, because this is not new. So Tribevest did not invent the fund of funds model, and we don't want to. We don't want to go into some territory where we're making up some kind of a legal entity and we're trying to test it. The fund of funds model has been tested, it's been proven, and it's actually always been a golden alternative, but to the co-GP model. But the problem is that now the ICA has to put their own fund together. And I mentioned that, they have to find their own CPA, they have to find their own securities attorney, they have to open their business bank account. And some of these folks don't do this full time, right? They're doctors, they're dentists, they're lawyers, they're engineers, they have full-time jobs, and they have a great investor network that you guys want to access, but they don't want to build a business and they don't want to have to put all these pieces together. And that's why the funds model before was really difficult to execute on, because they don't want to do that. It's just a lot of work. That's why sometimes they go in as a co-GP, because the lead sponsor will do all that stuff for them. But now they have to do all this stuff for themselves, and that's where Tribevest picks up the slack. So as you can imagine, it's expensive, it's hard to piece together, and until now, it's been really difficult for people to overcome that. But Tribevest makes it easy. We make it economical. We make it fast. As you can see, it's 5K setup, 7 business days to launch. That's huge. That's so fast. Like if you come to me at my law firm and you tell me, hey, I want to launch a fund of fund in 7 days, I'll be like, you're at the wrong place. Like you've got to go somewhere else, because there's no way. There's absolutely no way we're launching it in 7 days, 7 business days. It's probably going to be 3 weeks, maybe 4 weeks. If it's a sophisticated fund, much longer. So 7 business days to launch your fund of fund is insane. So you can actually have a deal under contract. Fund manager could come to Tribevest and launch their fund of fund and raise for that deal specifically. It's done for you. It's white glove investor onboarding, investor portal, tax and compliance, all this for the 5K setup fee, and not what I would charge, which would be like $25,000 or even more. When I worked at DLA Piper, which is a large law firm, we used to charge $75,000 just for the offering documents and the exemption filings. That's it. And then everything else is even more. That doesn't include all this other stuff that I mentioned for fund administration. So, and because of that, these economics make it feasible for ICAs to raise, as little as $500,000, and it makes their deal worthwhile. So, and not 5 million, because like sometimes the fund to fund model, the traditional fund to fund model says, look, if you want to get a securities attorney and a CPA and get all this fund administration, all these things, you probably need to raise $5 million. Maybe I used to say 7 million was kind of the level for me, but $5 million at least, and now you can raise 500K to make it economically feasible. We've seen people actually raise less than that depending on the deal, and they still come out on top. So lead sponsors, here's how it works. I'm going slower than I thought, so I'm going to pick things up a little bit. Lead sponsors, here's how it works. We kick things off with a consultation and a program and a design call, and you can see how we go from left to right, help you build your program. We have proven tools. You need to implement a successful program, like a program guide template, ICA funnels, how to reach ICAs, how to develop them, and how to develop rock solid fund to fund economics. We sign a partnership agreement to kick things off, and then you go find your deal. You start handing off qualified ICAs, and we start creating the fund to fund SPVs for your fund managers, and you just start getting big checks for your deal. And once it's built, it's easy. Then it's rinse and repeat. Again, we plug into your marketing, your sales, your investor relations without adding lift. That's the whole point. We're trying to make this easy for you. You don't have to handhold co-GPs anymore. You don't have to do these things for them. You just need to provide the tools for them, and we'll help you develop that. So there's no extra software, no extra staff, just streamlined back office execution. And here's the big question, which we already alluded to a little bit, but I just want to make it really clear. How much does it cost? And for you, the lead sponsor, it doesn't cost anything. It's zero, nothing. Like, we help you build this program for free. We just need your commitment. So we want to help you build your fund of funds program so we can create strong partnerships that lead to our paying customers, which are the ICAs. So I will say that it doesn't cost anything today, but we're finding that time after time, we're helping people build these programs. And it's, as you can imagine, it's extremely valuable. And at some point in the future, this is probably going to be some sort of a premium high ticket item to help you build this program. But for now, we're really trying to scale, and it's free to help us, or for us to help you build this program. So let's talk about what it costs the ICA. And again, not you. It's incredibly economical. There's absolutely nothing in the market that compares to this, and it just makes it a no-brainer for everybody. It's a 5K setup fee, and then 2K for fund administration annually that scales with the number of investors. So as the number of investors goes up, the annual fee goes up a little bit, and so it just depends on the size. But price compare that to what it would cost to piece all this thing together. It's not even in the same ballpark. So what you get with Tribevest, one-on-one program design consultation, all the templates that we've put together for an ICA, marketing funnel, program guide, fund to fund economics, execution priority with our team as a preferred lead sponsor partner. That is massive. We are a growing company, but we extremely value our partners. So folks that we've kind of been in the trenches with that have made the commitment, that said, hey, I want to be a lead sponsor partner with you guys. Those are the folks that they're going to get priority. So if you come to us like, yeah, I've got a deal and I've got 30 days or I've got 2 weeks to close this thing. Well, we're going to do our best to help you out, but doing it beforehand is really the way to go. And again, free to you. We monetize on the ICA side. And what we ask from you, we ask for a commitment. We're a real partner, not a vendor. We build the market. We build and market your program. And one of the biggest lessons I've learned as an entrepreneur in all walks of entrepreneurship, anything in business, if you don't fully commit to anything, whether that's a promotion at a gym or a capital raise or whatever it is, if you half-ass it, you will not be successful. That's it. And you guys have probably seen that before. You have to fully commit. If you just say, tiptoe around, it's just not going to work. It never does. Next, when you have a deal, send us your offering documents and your economics via our deal intake system. And all along the way, give us feedback, and so we can continue to iterate and improve, because that's what we do here at Tribevest. So why build a program now versus wait for a deal? When you have a deal, you're not going to have time to build a program. you're trying to close your deal. You're not going to want to do all these things. So build a repeatable funnel and a systematized ICA pipeline now. And because Tribevest does the heavy lifting and you've built your program, you'll be able to close your deal, close your equity quickly and fully. You'll be able to confidently offer on deals, scale your business, and again, once it's under contract, focus on closing your deal because you know that that equity channel is already there. So it'll help you build a sustainable business that lasts generations by delivering better results and experience for all stakeholders involved. So what are next steps? Schedule a consultation call. I'll provide the link at the end of the presentation. We're almost there. We'll set expectations on who does what. We'll provide all the powerful proven tools we talked about to build out your program. And most of our partners, just to give you some perspective, are able to launch a fully functional program in as little as 30 to 60 days. We've seen it done even faster than that. It just depends on how much time you have to commit to get these things hammered out and launched. All right, so let's open it up. Drop your questions in the chat, or you can even unmute if I can figure out how to do that, and I'll get in the weeds with you.
Seth, do you want to go to the slide for them to book a call? That way we can have that up while you're doing it.
Sure, yeah, let's do that.
Yeah, perfect. All right, let me.
Cool.
Cool. All right, everyone, feel free to put your questions in the chat. Let's get into the first couple here. Corey asks, do all the investors in your fund of fund have to be accredited investors?
They do not. So we typically encourage it. A lot of it is dependent on what the target deal or the lead sponsors deal is, right? So if it's a 506c deal that only allows accredited investors in the fund of fund, and then at the fund of fund level, then yes, all of those investors need to be accredited. But if the top level lead sponsor target deal is a 506b deal where it allows non-accredited investors, the fund of funds can have some non-accredited investors, and you'll kind of have to work that out, how those non-accredited investors are counted against your 35 maximum. But it depends on the deal structure. So you can have non-accredited investors depending on, again, how the target deal is structured.
Perfect. Robert has a good question here. Does Tribevest plug in with an existing investor portal? Do you guys work with multiple investor portals? How does that work?
Yeah, so right now we have limited, I'll say we have limited functionality if you choose to use your own investor portal. And that's because we're deeply integrated with you when you use our portal, right? So we open up your business banking account, which is integrated on our platform. We onboard your investors, meaning we send out the electronic signature requests and wire into that banking account that we created for you. All those things are integrated into our platform. So when you take that away from us, we're not able to do that. Like, we're not going to come on to one of the other investor portals and, you know, be your 1099 or something. It's just not possible. So a lot of the functionality goes away, but we do have options where you can do what we call docs only. So we can give you kind of the templated offering documents, and you can take those and host those on another platform. But again, a lot of the fund administration and the onboarding process goes away.
Perfect. I think this was a question in the FAQ, Seth. What have you found to be the best way to find these fund managers? If you're a lead sponsor looking for fund managers, what have been some of the best ways?
Yeah, I mean, the best way. So there are a couple different ways. One is to go out there, right, and look for them. So network, go to the events, talk to your friends, talk to the people in your masterminds, see who's raising capital, invite them to be one of your fund managers for your next deal. But what I mentioned before is you're just seeing that landscape becoming more and more competitive. You're seeing folks like Aspen and Lone Star host fund managers for like these really, really nice events and things like that. It's kind of turned into a wine and dine sort of thing. So you can attract them depending on your asset class and your deal and you as a person and as an operator. But the best way we're seeing right now is to actually look at your passive investors and see who might have the capacity to turn into a fund manager, right? And they might not even know it. A lot of those folks that are doctors and dentists, they already have that built-in trusted network of accredited investors or wealthy individuals that can invest. And they already have that built-in trust because they work with them as doctors. That trust is already there. Man, they can have some immediate success raising capital. So those folks, they might not even know that they're good at this, but they can be good at it. They can raise $500,000, $1 million really easily. And a lot of times they don't want to do it because there's a lot of work behind it that we had already gone through in this presentation. But when you implement the Tribevest program and you show them that, hey, look, you actually just need to populate your investor list and Tribevest does the rest, then they're like, and if you do that, then your returns go from a 1x as a passive investor to a 2 to 3x as a fund manager. That's attractive to them.
Perfect, cool. I think some of you may have had an issue with the QR code. I put the link to book a call in the chat. Yeah, that way you guys can just book a call. Um, Perfect, cool. Yeah,
Cool.
I see a couple of you already booked calls, messaging me. Great. Corey has a question. Does the 5K setup include all the documents for a 506B or 506C?
Yes, it does. It includes the offering documents.
Perfect.
Yep.
Awesome. All right, cool. Yeah, sorry about that. We'll get our QR codes fixed next time, but the links are the Calendly link, and then Brittany put the link to the Fund to Funds Accelerator in the chat as well. So if you guys want to access that, that is a
Yeah.
training for fund managers.
Yeah. Wanted to talk about that real quick. I mean, it's 8 hours, 8 hours long. It sounds like a lot, but there's so much value in there. It's in-depth training on fund to funds. What is it? How do fund managers get paid? What's the structure? What are the exemptions? All those things. And it's something that, mastermind scholars out there would pay for thousands of dollars for. And we've just made it completely free. And it's massive. Go check that out. If you're a lead sponsor, you can educate your potential fund managers with this. Feel free to share that with them and show them like, hey, you don't know anything about fund of funds, start this training, and then by the end of it, they're gonna know more than 99% of the population. So check that out for sure.
Yeah, that's actually a great point Seth brought up. I've had the privilege of helping a lot of sponsors with their fund manager webinars, and that's a really powerful way to do it is send out an email to your LPs, see who has a network or who may be interested, host a simple webinar, just like we hosted today, and you can send them the Tribevest training. It's a great way for them to learn more about it.
Absolutely. Yep.
Awesome. Anyone else have any questions? Let's see. Yes, Corey, that's correct. Yeah, like basically, if you're a lead sponsor, you would bring on 1 to 5 fund managers, depending on how much, you're raising. And then from there, it's like, each fund manager in my experience will bring on, 500K to $1 million. So, for example, one of the sponsors I work with, they were raising $5 million for a $9 million deal, and they brought in 2 fund managers to raise about $1 million for them. So that's kind of how they set up their fund manager program and did it in that way.
Yep.
Cool. Awesome. Yeah, let's see here. Seth, can you answer Robert's question in the chat?
Let's see. I'm a lead sponsor and also looking to set up a fund of funds to invest with other sponsors. Can I bring over legacy deals to your portal? Yes. Yes, you can migrate to us.
Awesome. And then Corey, I'm glad you brought it up. Like, what are the benefits of a fund manager doing this? Seth, it was included in the slides, but we obviously went a little bit long. So really, fundamentally, the fund manager will get compensated for raising capital. So, for example, if someone raises $1 million, they'll get paid about $100,000 over the lifetime of the deal. So it's just a way for someone to get compensated for raising money. That's really the simple answer.
Yeah, a good rule of thumb to figure out how much a fund manager might make for raising capital from their investors is across the industry we're seeing about a 10%. So if they raise $1 million over the life of, let's say, a 5-year value add multifamily deal, they'll make $100,000. I see Corey's question there, and they don't have to be a broker dealer to raise funds. No, they do not. There are, without diving too deep, you guys are probably familiar with the 1930s Acts, Securities Acts. That's the 506B, 506C type of exemptions. We have to file for those at the fund to fund level. But then we also need to navigate what's called the 1940s Acts, which is the Investment Company Act and the Investment Advisor Act. And there are certain exemptions and certain definitions that we need to work with in order to keep you compliant. but we certainly don't want you to become a broker dealer. It's a lot of work, a lot of red tape. Let's see. Dennis says, at what level can the fund of fund be considered an accredited entity itself? 5 million total, 25 million total. Trying to understand if there's any way that a fund of fund can reach accredited status as an entity. Thanks. Yeah, so I'll start by saying a fund of fund. Look at a fund of fund the same as you'd look at any other passive investor, because that's all it is, right? So how can you become a as a fund of fund? How can you become an accredited investor? Well, just ask yourself, how does any investor become an accredited investor? So as an entity, every single member must be accredited. That's the most typical way. So typically with the fund of fund, right, every single investor in that fund of fund is going to be accredited, and therefore the LLC fund of fund SPV is also accredited. But there are also certain benchmarks as well, like that $5 million that you had mentioned. But that's a little bit difficult to skirt because it can't be $5 million that you raise just because you want to invest in that deal. It has to be equity under management. There's some other different nuances to it. So, but typically the easiest way to do it to be accredited as a fund of fund is to make sure that every investor in that fund of fund is also accredited. Mr. Clace, can you talk a little bit about the importance of creating the fund of fund economics for ICAs and how many questions it answers for them? Yes, completely. So I'll say that people probably don't even know what fund of fund economics are, right? So I'll explain that. So at the lead sponsor level, at your level, you have your underwriting, right? You've got all your income and expenses and your fees and your distributions and your projections and all those things that you have for your specific deal. That's your underwriting. Well, how does that underwriting actually connect to the fund of funds underwriting? So going from the top level, from your asset through your kind of projections and your underwriting, and then from your underwriting, how does it flow down through the fund of fund, ultimately to the passive investor? That whole thing we call fund of fund economics. And that's probably the most confusing, as you can imagine, and also the most important part to get fund managers interested to raise capital for you, because they want to clearly know how they're going to get paid, how much they're going to get paid, and what their passive investors' returns are going to be. And in order for them to know those things, you as the lead sponsor need to know your underwriting, and you need to help them walk through the process all the way from your asset level all the way down to their passive investors. And that's a little bit new to you if you haven't worked with fund of funds before, and you'll have to help them do that. But we can also at Tribevest help you walk through that, and we've got some tools for you to do that effectively. Let's see. Shola, Shola. Sorry if I butchered that. Does your platform support lead sponsors who are involved in international real estate deals? Um, so a couple things there that can be interpreted a couple different ways. One thing is we don't host lead sponsors on our platform, so we are designed specifically for ICAs, for fund managers. So we don't host lead sponsor deals on our platform. Um, so I don't know if that was the question, but then talking about international real estate deals. Um, so your deal could be international, but we do have limitations as far as the passive investors being international, and that's due to our vendor partners at Stripe. But as far as like your actual lead sponsor deal being international, that should be okay. Jeff asked, does your services include the bookkeeping on the fund of fund? I wouldn't call it bookkeeping, but I think the answer is yes. So we have a banking log on there, and everything's on there. And you have to think about the simplicity of the fund to fund. We're not dealing with, let's say, a apartment building where you have all these different expenses. You have 100 different units with 100 different income lines. We're at the fund to fund level. All you're seeing are distributions from the target deal as a passive investor, and then you're seeing maybe fees come out that the fund manager is charging their fund to fund, and then perhaps some really limited expenses like maybe the Tribevest annual fees, or perhaps maybe I don't know. There could be some other fund manager expenses in there for software or for travel or whatever it might be. There's just not much there. So it's very simple. So a simple bank log of transactions is good enough for bookkeeping there. And then we provide the K1s to your investors. So in order to produce those K1s, we actually use that banking log. Robert asks, can you use your own banking relationship or does it have to be your banking relationships? That's a great question. Brittany, do you know the answer to that?
Uh, you could if like you did docs only with us, um, and just, did but that would be like you're doing your investor onboarding and everything yourself. So I think it's
Hmm,
obviously an option, but to like bring your own banking relationship to our platform is not a thing at the moment.
got it. Hey, Robert, I mean, another cool thing that you could do there is like, you could have your own banking relationship that is, let's say, your management entity, right? That you host at your own Chase or wherever you do your banking at. But then the fund of fund entity itself that we create would have, the Tribevest created banking account, but then you can still, you collect fees and everything that flows to you as the manager can flow to you there. So you can still kind of do your own personal banking there.
Cool. Awesome. I think obviously we put the link for Cam. Just obviously if you have follow-up questions, please book with them. I know a couple you already have, so should be good. Anything else, Seth, you want to leave us off with?
I think that's it, guys. Book a call with Cam, and we can kind of get you started, get you going in the right direction. And I know that all of you probably aren't lead sponsors. There's probably some fund managers out there as well. If you're interested, go ahead and book a call as well, and we'll get you started. And then, want to reach out to me, feel free to follow me and find me on any of the social media platforms. I'm all over the place. Thanks, everybody.
All right, thanks everyone.